Just before Christmas, I invited any one of our followers to submit a request of a stock or anything they wanted, and we would be happy to plug it into what we call our swing machine and show you what the swing machine, how it would have traded it in those results. I'm Bagger Don at StockMarketCaddy.com. It is actually January 1. The markets are closed, and we thought we did get a request from a gentleman. I'm not going to name him, but I wanted to send him a personal copy and say thank you. And as an opportunity to maybe teach others, I'm going to upload it to the internet. That's why I don't even want to disclose his first name. Not that there's anything, but I respect everybody's privacy. I just want to remind everyone that we are not a financial advisor. We are not a broker. We are not making a recommendation to buy or sell anything. We are not making a recommendation that everybody should be a trader. Not saying that at all. In fact, we are traders of our own money, but we are also investors. But we have long-term trading strategies that I suppose may qualify us to be even long-term traders. We have exit strategies. So his request was the SPY, which is one of the largest ETFs. It's the S&P 500, which is a good place to start. I will say this, though, that the swing machine, the technology that we use and the strategy we use, we kind of view it almost as you might say, if you were to do a car analysis, as a Maserati. So, the SPY, that's kind of like driving your Maserati down Main Street, as opposed to maybe the Pacific Coast Highway or the Teeth of the Dragon down there in Tennessee, where you can really test the not just the speed on the straightaways, but the turning power and what have you. But that was the request, so we want to fulfill that request. Okay, and but I'm also going to do not just the SPY, but I'm going to show you what the banks trade as well instead of the SPY. Again, it being an exchange-traded fund, very popular with the masses, and it's fine. From an active trading vehicle, though, it's not something that we would be using, and I'll explain why. So one of the things that I had to do is change the strategy. The strategy is the Zinger. You're looking at indicators, by the way. Some are proprietary, some aren't. These have nothing to do with the Zinger. These little bands here, though, are very neat. They're proprietary to us. I don't like the Bollinger so much because they flex and don't stay rigid, and these do. But these two also don't have anything to do with the Zinger. The Zinger runs behind the scenes and will enter short, cover, short, or buy, which it's still in a buy. The gentleman did ask for a 1-year status, but I actually wanted to go back a little bit further. I went back 2 years because the strategy needs some data to generate trades, and it needs about 30 to 60 days worth. So I didn't want to shortchange, and so we wanted to go back and look at the last 2 years. So we come here and we look at the last 2 years, and this is the performance graph. Had a high water mark of about $3,000. And let's go to the performance summary, and you can see here the performance summary is $1,679. On $10,000, that'd be a 16% return. Not all bad. I don't know what the market did last year, but more or less in line, maybe a little bit better. The profit factor is all important, is 1.863 on the long side and just 1.4 on the short. What is a profit factor? I'll read it to you. A profit factor displays the amount made in relation to the amount lost. This value is calculated by dividing gross profit by gross loss. By definition, a value greater than 1 means the trades have a positive net profit. Profit factor is very important, and I'll just share this with you. If anybody is talking about, we win 70-80% of the time, that's all well and good. A winning ratio is also important, but I would say a profit factor is much more important because a person can win 7 or 8 out of 10 times and still lose money if they have a real bad negative outlier. I would take a much higher profit factor over a winning percentage any day. So that's important to see. And we scroll down, it was basically 16 trades, and this does include commissions. Percent profitable is about 43% because it is more or less of a trend following system. We don't use averages, though. Averages do not work. And the Zinger is just very unique and, again, proprietary. We had a drawdown of about 422 max trade drawdown, and that isn't all bad. Okay, so we show you that, but now what I'd like to do is take the Maserati, and which is the swinger, and the Zinger. It's kind of a swing, trading system, but we're going to put it on a futures contract, an ES, we'd call an ES futures contract, and which is what the banks trade. And let me show you what it looks like using a futures contract. First, I got to load it in. So I'm going to hit this little linking mechanism, and I'm going to load in the ES contract, and hopefully it comes up. There it is there, the ES. And now what I need to do is change it from $10,000. That was trading. The SPY, I had to allocate $10,000 in shares to come up with a number. With the futures contract, it's a contract, and that contract trades with a $5,000 margin. So I need to, in order to see the strategy, I need to change that amount from $10,000 where we're trading the SPYs to one contract, which is $5,000 in required margin to trade a futures contract. And let me do that. Okay, so now what we've done, we're running the exact same strategy, but instead of running it down Main Street, we're running it 2 years over this exact same period of time over the S&P 500, but we're using a futures contract that uses much more leverage. Instead of using $10,000, a $5,000 contract in the S&P futures is probably controlling about $100 some odd thousand of S&P. So you see a lot more trades. This road, if you will, is much like the Pacific Highway or the Dragon Road in Tennessee. A lot of turning, a lot of turns, a lot of sharp turns, and you're going to need something that can perform. So let's see what it does. Come in here, and here it is, 12,441, significantly higher. 11,300 some odd on the long side, 1,000 on the short side. Profit factor is 1.67, 4.77 on the long, 1.07 on the short. Interesting. Total number of trades, 66%, profitable 90, 58 on the long, 96% profitable, which is excellent, 8 on the short, 50% profitable. Let's scroll down. Now there is a bit of a weakness here. Look at the drawdown. We had as much as 7,000 drawdowns on one trade, $7,800. Significantly, higher. It is a leverage product. So the Zinger does quite well, especially in terms of percentage of return. We're using $5,000 to generate a return of $12,441. So we're not getting the return is actually, divide that by 5, is actually about 220 some odd percent. This is where the banks play. This is where we play. When you have an automated system that can be, if you will, coded to have a multiple of exits and try to control your risk, you can play in these leverage markets, but these decisions need to be made fast. So this is just a basic comparison. We can actually improve upon that, running it real time with additional stops and try to reduce that overall risk. But I just wanted to show that gentleman. I thank him for asking us to plug in the SPY on the swing machine. And we wanted to show you what the results would have been. We also wanted to plug in a comparable futures product over the exact same time, running the exact same strategy so that you could see the performance difference. Traders, the markets are not all the same. My earlier business used to be in the hospital teaching surgeons. I think a lot of people think hospitals are the same once you get in the hospital. God forbid, I hope nobody goes there. But the reality of it is they're all different, and the market is different. The market is different from day to day, week to week, month to month. There are various markets, and within the market there are various products. Some are suitable for long-term investors, some are suitable for trading. whether or not, and I'm not even passing a judgment on the SPY as to whether or not it's suitable for long term. Just in the last 20 years, we've had 2 or 3 corrections that have been more than 50%. If you're should be within retirement of any and catch one of those hellacious corrections, it could be very unsettling. I mean, even this past year, yes, on balance, the S&P generated a 6% return. I hope you all get it next year. Could it correct 50%? Sure. Would that be natural? Yes. Would there be a lot of pain? Absolutely. So I think that has to go into one's equation. It certainly does with us as traders. We're trying to limit our drawdowns, limit our risk, and try to control. Much like driving that high-speed performance automobile, we want to try to keep the car on the road, hugging the road, and maintaining the speed, maintaining the corners, and trying to measure and maintain our risk. Alrighty, if there's anyone else that would like an example, feel free. I'm Bagger Don at StockMarketCaddy.com, and we can't wait to get these markets open again tomorrow, and off and running we go again. Thanks. We'll be in touch.